January 30th, 2026. Silver hit $121.62 per ounce, the all-time high. Mainstream media celebrated it. Retail investors cheered. Financial influencers posted rocket emojis. And then, in less than 18 hours, it crashed to $74. 40% of its value, gone, evaporated. 1.34 billion ounces of paper silver traded on the Shanghai Futures Exchange in a single morning session. Let me repeat that number because your brain probably didn't process it. 1.34 billion ounces. That's double the entire annual global mine production of silver, traded in one morning, not over weeks, not over months, in hours. This isn't market volatility. This isn't a correction. This isn't even a crash in the traditional sense. This is wealth redistribution at a scale and speed you've never witnessed in your lifetime. And if you think this was random, if you think this was retail panic selling, if you think some algorithm just misfired, you're not paying attention. This exact pattern, this exact sequence of events has appeared 3 times in recorded history. And every single time, without exception, it marked the terminal phase of an empire's currency system. Let me take you back. Rome, 3rd century AD. They called it the crisis of the 3rd century, and it nearly destroyed the greatest empire the world had ever seen. The denarius, Rome's primary currency, was once struck from 95% pure silver. It was trusted across 3 continents. It financed the legions, built the roads, paid for the Colosseum. But then the wars became endless. The Germanic tribes, the Persians, the civil wars, emperor after emperor, 30 emperors in 50 years. The treasury was empty, so they did what every desperate government does. They debased the currency, they reduced the silver content, first to 90%, then 80, then 50. By the time of Emperor Gallienus, the denarius contained less than 5% silver. It was basically copper with a silver wash. Soldiers refused to accept it as payment. They demanded payment in gold or land. Inflation became so catastrophic that prices doubled every 15 years. Trade collapsed. Cities emptied. The tax base disintegrated. And 20 years after the worst of the debasement, the Western Roman Empire effectively ceased to function as a unified state. The silver left the money, and the empire followed. Verified. Check the metallurgical analysis of Roman coins in any major museum. The timeline is exact. Fast forward to the Netherlands, 17th century. The Dutch guilder was the world's first true global reserve currency. Amsterdam was the financial capital of the planet. The Dutch East India Company was the most valuable corporation in human history. Dutch banks pioneered modern finance, letters of credit, bills of exchange, stock markets. They invented the system we still use today. The guilder was backed by silver and trusted everywhere from Japan to Brazil. But then came the wars. 4 wars with England over trade routes and naval supremacy. The 80 Years' War with Spain, the 9 Years' War with France. War is expensive, catastrophically expensive. The Dutch government began borrowing. Debt exploded from manageable to unsustainable. They started debasing the coinage to pay the bills. The silver content dropped. Trust eroded. By 1795, the Dutch Republic was bankrupt, militarily defeated, and occupied by French revolutionary forces. The guilder lost reserve currency status and never recovered it. The Dutch Golden Age ended not with a bang, but with a whimper. A monetary whimper. Same pattern, same sequence, same outcome. Britain, 20th century. The British pound sterling had been the undisputed global reserve currency for over a century. The sun never set on the British Empire. London was the center of global finance. The pound was as good as gold because it was convertible to gold on demand. Then came World War I, the war to end all wars. Except it didn't end anything. It bankrupted Britain. Debt to GDP went vertical. The government suspended gold convertibility during the war and tried to restore it afterwards at the old parity. It didn't work. The economy collapsed. Unemployment skyrocketed. In 1931, Britain abandoned the gold standard permanently. World War II finished the job. By 1945, Britain was financially destroyed, dependent on American loans, and forced to accept American terms. The United States took global reserve currency status at the Bretton Woods Conference in 1944. The pound lost 2/3 of its value over the next 3 decades. The empire dissolved. Reserve status never returned. Verified. Check the Bank of England archives. The timeline is documented down to the day. You see the pattern now, don't you? You can't unsee it. Currency debasement to fund unsustainable government spending. Exponential debt growth. War or major financial crisis. Loss of precious metal backing. Then collapse of reserve status and empire. Not might collapse. Not could collapse. Will collapse. This is not opinion. This is not conspiracy theory. This is pattern recognition across 2,000 years of monetary history. And right now, at this exact moment, the United States is in the exact same sequence. Stage 4, the terminal stage. The endgame. Let me show you the data they don't put on the evening news. U.S. national debt just crossed $36 trillion. $36 trillion? The human brain can't even conceptualize that number. If you spent $1 million every single day, it would take you 98,000 years to spend $36 trillion. Debt to GDP ratio is now above 123%. That's higher than World War II peak levels. And here's the part that should terrify you. Interest payments on that debt now consume over $1 trillion per year. $1 trillion just to service the interest, that's more than the entire defense budget, more than Medicare, more than anything except Social Security. The government is borrowing money just to pay the interest on money they previously borrowed. That's not fiscal policy. That's not Keynesian stimulus. That's a Ponzi scheme. And everyone in Washington knows it. They just can't say it out loud because the moment they do, confidence collapses and the game ends. But the real story, the story that connects directly to what happened on January 30th, is playing out in the physical metals markets. And almost nobody is watching it. COMEX silver inventories have collapsed from over 500 million ounces to 415 million ounces in just 4 months. That's a 22% decline in available silver. But the registered category, the metal that's actually available for immediate delivery, that's where the crisis is concentrated. During the first week of January 2026, 33.45 million ounces were withdrawn from COMEX warehouses in 7 trading days. That's 26% of registered inventory in 1 week. In December 2025, 47.6 million ounces were claimed for physical delivery in the first 4 trading days of the month. 60% of the registered inventory claimed in 4 days. These aren't normal numbers. These are panic numbers. These are the numbers of a market where the people holding contracts no longer trust the system to deliver. And here's what makes it even more extraordinary. Normally, 1 to 3% of futures contracts result in physical delivery. Everyone knows the game. You buy a contract, you sell a contract, you settle in cash. Nobody actually wants the metal delivered, except that's changed. Settlement rates for physical delivery hit 100% in multiple contract months. 100%. Every single contract holder is demanding the actual metal, not cash, metal, because they figured out what's actually happening. The paper markets and the physical markets have diverged. They're operating in 2 different realities. And when that divergence gets too wide, something breaks. Now connect this to what happened on January 30th. Silver hits an all-time high of $121.62 on January 29th. Record high. New paradigm. Media coverage everywhere. Then, in the middle of the Asian trading session on January 30th, the bottom falls out. 1.4 million contracts get dumped on the Shanghai Futures Exchange in 90 minutes. Not bought, sold, aggressively, systematically, violently. That's 674 million ounces of paper silver sold in a single morning session. To put that in perspective, total global annual mine supply of silver is approximately 1 billion ounces. Someone just sold the equivalent of 67% of annual global production in 90 minutes. There isn't that much physical silver available anywhere on Earth to deliver against those contracts. This wasn't natural selling pressure. This wasn't investors taking profits. This was a coordinated assault. A surgical strike designed to accomplish one objective: crash the price and liquidate the leveraged positions before the squeeze becomes uncontrollable. And it worked. Price plummeted from $121 to an intraday low of $74. Margin calls triggered across the system. Retail investors who bought at 90 on leverage got wiped out. Stop losses hit. Forced liquidations cascaded. Billions of dollars in retail capital transferred from weak hands to strong hands in hours. The Shanghai Futures Exchange reported it was one of the most violent moves in the history of Asian commodity markets. An 8 to 9 sigma event. Those don't happen naturally. Standard market movements are 1 or 2 sigma. 3 sigma is rare. 8 sigma is manipulation, mathematical certainty. Now here's where it gets really interesting. Here's where you start to see who actually benefits. JP Morgan was fined $920 million in 2020 by the U.S. Department of Justice for manipulating precious metals markets through a practice called spoofing. They would place fake orders to move prices, then cancel the orders and trade in the opposite direction. They did this thousands of times over nearly a decade. They were caught. They admitted wrongdoing. They paid the fine. And they kept their trading licenses. They didn't stop manipulating. They just got better at it. They learned how to do it in ways that are harder to prove. And when silver was at $70, $80, $90, JP Morgan and the other major bullion banks were massively short. Billions of dollars in short positions. Market data and CFTC reports indicated substantial short positioning by major banks as of late December 2025. If silver had continued to 150 to 200 to 300, those short positions would have triggered margin calls that could have bankrupted them, or at minimum cost them billions in losses. So what do you do if you're holding a massive losing short position and the price is running against you? You can't just cover. There's not enough liquidity. Buying back your shorts would drive the price even higher. You'd get squeezed. So instead, you crash the market. You coordinate with other large players. You wait for maximum leverage in the system. You wait until retail is all in, buying at the top with borrowed money. And then you dump a massive volume of paper contracts in the thinnest liquidity window available. Asian session, middle of the night in New York. And you do it on Shanghai because Shanghai has different rules, different margin requirements, different oversight. The crash happens there first. It cascades to London, then to New York. Stop losses trigger. Margin calls hit. Liquidations accelerate. And at the bottom at $74, you close your short positions at a massive profit. Then you flip and go long. The smart money didn't lose in this crash. The smart money engineered it to extract maximum profit from retail panic. Bloomberg reported that a UBS joint venture fund in China revalued its silver holdings by 31% in a single day after the crash, sparking fury among investors who lost massive amounts. The fund claimed market prices had moved so violently that standard net asset value calculations no longer applied. Translation? The paper market and the physical market were so disconnected that they couldn't even figure out what the metal was actually worth. The Shanghai Futures Exchange responded within 48 hours. They raised margin requirements to 21% for hedging positions and 22% for speculative positions. Daily price limits were expanded to plus or minus 20%. Why? Because the system is breaking. Because the amount of leverage in the paper futures markets can no longer be sustained when physical demand is this concentrated and this intense. They're trying to reduce volatility by increasing costs and restricting price movement. But that doesn't solve the underlying problem. It just delays the inevitable reckoning. Because here's the part they desperately don't want you to understand. While paper silver crashed 40%, physical silver premiums exploded. The spread between Shanghai spot prices and COMEX futures widened to over $10 per ounce. $10. In normal markets, that spread is 20 to 50 cents, maybe $1 during periods of stress. $10 means two completely different markets operating under two completely different pricing mechanisms. Paper silver, which exists on computer servers and can be created infinitely with a keystroke, crashed. Physical silver, which actually exists in finite quantities in vaults and refineries and cannot be created out of thin air, held its value and even commanded massive premiums in certain markets. That dislocation is the signature of a broken market, a market where price discovery has failed, where the paper price no longer reflects physical reality. China knows this. That's why Chinese buyers were paying $10 premiums even after the crash. Russia knows this. That's why Russia has been accumulating gold and silver reserves for a decade. India knows this. Indian households hold more physical gold than any central bank on earth. These aren't backward economies clinging to old superstitions. These are sophisticated players who understand that when the Western financial system breaks, and it will break, the only money that will matter is money that exists physically. Money you can hold. Money that can't be deleted from a database or frozen by a government or devalued by a central bank. And now even U.S. states are starting to wake up. The state of Wyoming just began accumulating physical gold reserves and deliberately selected a private vault over J.P. Morgan's custodial services. Think about that. A U.S. state doesn't trust J.P. Morgan enough to hold its gold reserves. That should tell you everything. Institutions are moving. Quietly, without announcements, without fanfare. Central banks purchased over 1,000 tons of gold in 2025, the highest level in decades. That's not investment, that's preparation. They're preparing for a monetary reset, for a repricing, for the moment when confidence in the dollar system finally breaks. And when that happens, and it's not a question of if, but when, let me describe what it looks like, not as speculation, as historical pattern. You wake up one Tuesday morning, silver is limit up on COMEX, gold is limit up, trading is halted, you check the news, COMEX has announced force majeure, they can't deliver the physical metal to contract holders, there's not enough in the vaults, they're offering cash settlement at prices significantly below the current market. If you own silver ETFs, unallocated accounts, or paper contracts, you get paid in dollars, not metal, dollars. Dollars that are simultaneously losing purchasing power because the dollar index is plummeting as foreign holders realize the U.S. can't meet its commodity delivery obligations. Meanwhile, physical silver disappears from the retail market entirely. Dealers have no inventory. The websites say out of stock. The premiums that do appear are $50, $70, $100 over the now meaningless spot price. You can't buy physical silver at any price because there is none available for sale. Industrial users panic. The companies that manufacture solar panels, semiconductors, electric vehicle components, military electronics, they all need silver. It's not optional. You cannot make these products without silver. There is no substitute for most applications. They start calling suppliers, offering double, triple, 10 times the normal price. Bidding wars break out. The price discovery mechanism shifts entirely from the paper exchanges to private negotiations between producers and industrial consumers. And that's when the real revaluation happens. Not to 120, not to 200, to 500, to 1,000, maybe more. Because silver isn't just money, it's the most critical industrial metal of the 21st century. You cannot build the AI infrastructure without it. You cannot manufacture advanced weapon systems without it. You cannot execute the green energy transition without it. And the world is desperately short of it. Here are the numbers they don't emphasize. Global annual silver mine production, approximately 1 billion ounces. Industrial demand alone, 600 million ounces and growing. Investment demand, surging as people wake up to the debasement of fiat currencies. Jewelry and silverware, another 150 million ounces. The math doesn't work. There's a structural deficit that's been papered over for years by recycling, by selling central bank stockpiles, by convincing investors to hold paper instead of metal. But those buffers are exhausted. Recycling can't keep up with demand growth. Central banks have sold what they're willing to sell, and investors are demanding physical. The COMEX inventory drain proves it. The 100% physical settlement rates prove it. The Shanghai premium proves it. The market is trying to tell you something. It's screaming it. Are you listening? This is not a crash. This is the final wealth transfer. Capital is moving from paper to physical. From those who trust the system to those who understand the system is designed to extract wealth from you. Every single one of these violent takedowns, these coordinated liquidations, these engineered crashes, they're not destroying the bull market in precious metals. They're accelerating it. They're shaking out weak hands who bought on margin, who don't understand what they own, who panic at the first sign of volatility. And they're allowing strong hands, sovereign wealth funds, central banks, family offices, billionaires to accumulate physical metal at artificially suppressed prices. This is a feature, not a bug. This is how wealth transfers from the middle class to the elite during monetary transitions. It's happened every single time. Here's how history is likely to remember this period. 2025 to 2026 will be seen as the turning point, the moment paper markets lost credibility and physical markets took control of price discovery. You cannot sustain 300 paper claims for every real ounce forever. Eventually, people demand delivery. Eventually, someone calls the bluff, and when that happens, the structure collapses under its own weight. What we're watching now is that collapse unfolding in slow motion. The January 30th crash wasn't a solution. It was a delay, a temporary patch on a broken system. The deficits remain, the debt keeps growing, the debasement continues. History shows this pattern clearly. Empires debase their currency to fund wars and promises they can't afford. Rome did it, the Dutch did it, Britain did it, and now the United States is doing it. Massive money creation, exploding debt, losing control of real assets. We're not approaching the edge anymore, and we've already stepped off. Gravity hasn't finished its work yet, but it always does. The system isn't going to break someday, it's breaking now. The only real question is where you're positioned when the transfer becomes undeniable. Bonds are collapsing. Traditional portfolios are failing. Institutions still hold almost nothing in gold and silver, but when they shift, even slightly, there won't be enough metal. Prices won't rise gradually. They'll reprice violently. The old paper-based pricing model is dying. A physical-driven system is replacing it. And in that system, only real supply and real demand matter. Here's what you need to understand at a visceral level. This volatility, this chaos, this violence in the markets isn't a flaw, it's a feature. It's how the system tries to maintain control as it starts losing it. Every crash is designed to scare you, to make you doubt yourself, to force you to sell at the worst possible moment. And when you sell in panic, your wealth doesn't disappear. It transfers from the unprepared to the prepared, from the leveraged to the patient, from paper holders to physical holders. We've seen it again and again. Retail buys near the top, panics on the drop, and gets wiped out. Institutions short the peak, trigger the collapse, cover at the bottom, and walk away with billions. Meanwhile, the person holding physical metal, who understands the bigger picture, doesn't sell a single ounce. They're not trading. They're preserving wealth. A 40% crash followed by massive physical premiums isn't normal. It's a system under extreme stress. Paper prices and physical reality are drifting apart. Debt is still massive. Supply deficits still exist. Demand is still growing. What's changed is that more people are demanding real metal, not promises. And when that happens, the system panics. It manipulates, it tightens, it crashes prices. But each time it loses credibility. History shows what comes next. Paper collapses, physical survives. The only question is which side you're on.